This is the only video you need as a trader to avoid false breakouts and also learn the best ways to trade breakouts in order to avoid losing your breakout trades. And as you pay undivided attention to everything that I will be teaching you in this video, you will begin to learn how to start trading breakout profitably and continue making consistent profits on your portfolio. In this video you will learn 1. How false breakout happens. 2. Why traders keep falling for the breakout traps. 3. The 2 best strategies you will use to trade breakouts in order to avoid false breakouts. 4. Pro tips. As you journey into the concepts and secret tips I will be showing you as we move on in this video, subscribe to our channel, and as you subscribe, you can turn on the post notifications as you will be getting more high-quality educational trading videos from us. Before I show you how false breakouts occurs on the chart, let's first understand the real meaning of false breakouts. When traders analyze price action, one of the most used tools for price action is the chart patterns. The chart patterns includes patterns like the triangular patterns, the symmetrical triangles, ascending triangles, and more, the double tops and bottoms, and many other chart patterns tools. As all these patterns move and form in their own unique way, many traders will always wait for a breakout to confirm the pattern in order to make sure they enter in a low risk, high reward ratio. When you look at these chart patterns on your screen, you can notice how they all suggest breakout, and the problem is not knowing if there would be a breakout or not. Where traders begin to find it difficult is how to identify the best breakout structure when a breakout finally occurs, and the best breakout strategy remains a mystery to 99% of traders. The price moves in different behaviors when there is a breakout. Sometimes it acts as though it's breaking out of the chart. Then the next thing you start seeing it return back into the structure box, and at this point it has cleared a lot of traders' stop loss. The second behavior moves in a similar way like the first one, only that this time it breaks out of the box, pick up trades, and goes down a little to take away stop loss, and then begin to move in the target direction after clearing the stop losses. This behavior can break your heart because you not only lose your trade, you can also see the trades going your target direction after losing the trade and being taken out of the position. The third way of the breakout is this one that breaks out with very high volatility. It's so fast that traders can't even get into the trade before it breaks out, and this is the type of breakout that makes traders get a fear of missing out when it happens. It does not wait for any trader. In the minds of many traders, this is the first thing they think of when expecting a breakout trade, and so they find ways to enter the trade quickly immediately they see price moving out for a breakout. And this also most time turns out to be a losing trade, trapping a lot of traders into losses. Many times, these are manipulations done by the big banks and large hedge fund traders in order to trap retail traders and take them out early, but still yet, there is a way to avoid these false breakouts and dodge the hedge fund traders' traps. The question in your mind could be, why do all these traders keep falling for these traps, despite all these years, and keep gifting money indirectly to the big banks and hedge fund traders? Here is your answer. The first reason why traders fall for breakout traps is because they place limit orders on the breaking point. Limit orders include sell limits and buy limits. When a limit order is placed, traders expect their trades to be executed immediately it touches their price limit. When price breaks out to the downside, it triggers their sell limits and sells the trade automatically, and when price breaks out to the upside, it buys the trade automatically and places them in trading positions. But there are a lot of disadvantages to this, and some of them You can see already on the chart. Imagine you are the trader that placed this sell limit order here, and the trade moved a little pips down here, and then later retraced into the box. Now you have been taken out of the position due to a false breakout. Now let's say this is Elijah. Elijah perceived that the market will break out at the top, and he rushed and placed his buy limit order in order to get in early on the trade. His buy limit order was executed correctly, but the market throws a big one at him. It rose a little and then falls back to take out his stop loss and then continue moving his way. He was full of surprise and confusion. First you are in the trade, and the next thing you are out, and later you see price moving in the same direction which you predicted it to go. This is what happens to 90% of traders that trade breakouts using limit orders. If you want to avoid the false breakout traps, then you must avoid placing limit orders. The second trap is the tiny retracement move, and this is very popular with breakouts. When the price breaks out of a zone, you will find tiny retracement like this one. Traders who are more patient than those who trade with limit orders will usually end up taking these tiny retracements. And these tiny retracements, 80% of the time they show up, ends up as a trap by big institutions to take out stop loss of retail traders. And how you know is that it appears faster, and it's always very close to the breakout levels. Anytime you see this little retracement, avoid it. The third thing that traps traders into a fake breakout is a very popular problem among traders, and you may be able to guess it already. The problem is not following the trend. 90% of the times breakout occurs, it always moves according to the former trend movement. Expecting pattern breakouts to break out against the trend will make you lose a lot of trades, though you can also use breakout pattern as reversal strategies, and that's only if you understand how market reversals work. If you want to know more about market reversals, check out my video on reversals. As you see this pattern here, it's working in a downtrend, and that's why after all the false breakouts, it still moved according to the last trend direction before the pattern occurred. That's the power of trends. Now the final trap before I show you the best strategies to trade breakouts. It is called the fear of missing out. It is the fear of missing out on a breakout trading opportunity that makes traders place limit orders. That same fear is the reason why many traders enter the small retracement moves. They are afraid that the market will leave them behind if they don't act fast and join the trade. But trading is not a game of emotions, it's a game of strategies. You can only be profitable if you know what works. And since you have known all the possible traps that may have been coming your way as you trade breakouts, let me now teach you the best strategies in trading breakouts. 1. The bigger retracement. The bigger retracement is the first ultimate solution to avoiding false breakouts and trading the breakouts profitably. This one strategy helps you to get rid of the 3 breakout traps instantly: the limit order trap, the fear of missing out, and the small retracement trap. This bigger retracement most times show up after the small retracement move. As banks are trying to get rid of small retail traders, they appear bigger in price movement than the small retracement move. You can lightly call it the senior brother of the small retracement move. Here are the rules to this strategy. 1. It must have a good space to the breaking line when it retraces. 2. It must not retrace more than halfway into the pattern box or triangle. After that, the next thing is the entry candlestick when it touches the breaking point, and we are going to be making use of the bullish and bearish momentum candlestick depending on the trend. The momentum candle should appear immediately after the last opposite candle or after one target direction candlestick. Here is what I mean. Take a look at this example. We are in a downtrend, and we are looking forward to sell this trade after spotting our bigger retracement move. And when the bigger retracement move has appeared, we want a strong momentum candle to appear, either after a bullish candle or after one bearish candlestick, which appeared after the last bullish candle. If 2 bearish candles form before the momentum candle, then it should not be traded. But for this trade, you can see that the bearish momentum candle formed after one bearish candle, and that will qualify us to trade this particular breakout. Let's take a look at another example. The market was moving in a downtrend, then we spotted an ascending triangle chart pattern, drew our lines and waited for a clear breakout. After the clear breakout, the market retraces to the trade line as a big retracement move, in line with the set out rules, and then a momentum candle appears after one bearish candle, which qualified it for a trade. You can place your take profit target at any point of your choice, but your stop loss must always be just a tiny pip at the top of the big retracement candle. Don't place it much further than that. And that's it. The take profit got hit and the trade was successful. Now it's time for me to show you the next strategy for trading breakouts. The next strategy is the quick retest strategy. I call it the quick retest because it happens so fast that it is only observed by 2 candles. This strategy is the simplest of all, but there are rules that guides it, in order to make it simple. Here are the rules. 1. Pure movement. The previous candles prior to the retest must have a pure movement. This means that, in a downtrend, if the candles are going down towards to the breakout spots, they must all be going down in threesome color, as bearish candles, before the quick retest formation. The second rule is that one of the 3 components of the retest movements must be touching the breaking point. These 3 components include 1. The candle before the 1 candle retest, the 1 candle retest candlestick, and the candle after the 1 candle retest candlestick. If these 2 simple rules are met, then you enter the trade and apply good risk management. The reason for the pure move is that it signals the full force of the sellers, driving the market downwards at a very high speed and control. Then at the breaking point, the buyers tried to intrude, but they were taken out immediately by the sellers, and the sellers continued to keep the strong momentum going. Our stop loss will be placed a few pips above the 1 candle retest and the take profit target at any good level of your choice, and if I were you, I will place it anywhere around here, targeting the same size of the box which it broke out from. Trading breakouts can no longer be a problem to you. With these 2 strategies, which I have taught you in this video, sometimes you may need to rewatch this video multiple times in order to absorb every rule and guidelines in it, till it becomes part of your trading life. Share this video to that your friend or your group that you feel really needs to watch this video, so that you all can be making profits together. And as you do that, subscribe and turn on post notifications so you don't miss out on any of our future strategies. Personally, I trade Deriv synthetic indices, and I have a VIP group where I share 90% accurate trades on synthetic indices for as low as $50. You can join our monthly subscription plan and start making profits with us. Check the description box for the link. See you in our next video.